How do you implement ratio spread hedging? Have you ever wondered how traders manage risk while aiming for profits in options trading? One effective strategy is ratio spread hedging. Let's break down how to implement this approach step by step. First, you need to select the type of ratio spread you want to use. There are two main types: call ratio spreads and put ratio spreads. A call ratio spread is generally used when you have a bullish to neutral outlook on the market. On the other hand, a put ratio spread is more suitable for a bearish to neutral outlook. Next, you will choose your strike prices and the ratio of options. Typically, you buy fewer options at one strike price and sell more options at another strike price. Common ratios include 1:2 or 1:3. For example, in a call ratio spread, you might buy one call option and sell to call options at a higher strike price. In a put ratio spread, you would buy one put option and sell to put options at a lower strike price. Once you have your strike prices and ratio, the next step is to establish your position. You will execute these trades simultaneously to create your ratio spread. The long options you buy are usually further out of the money or in the money, while the short options you sell are closer to the current stock price. Now, let's talk about delta neutrality. Initially, you want your position to be delta neutral. This means that the sensitivity to small price movements in the underlying stock is balanced. This balance helps reduce directional risk. However, as the underlying price moves, the delta of your long and short options will change. You may need to actively manage your delta risk by adjusting your position or using shares of stock to offset any delta risk. Managing risk is key, especially with ratio spreads. These spreads can carry risk if the underlying price moves significantly. It is important to monitor gamma risk, which is the rate of change of delta, particularly as expiration approaches. This helps you avoid large losses from rapid price movements. When it comes to profit and loss characteristics, the maximum profit typically occurs when the underlying stock price is near the short strike price at expiration. While losses can be limited, they may become substantial if the stock price moves sharply beyond the strikes where you have sold options. If the underlying price moves in an unfavorable direction, you can adjust your ratio spread. This might involve buying or selling additional options or shares to maintain a hedged position and control your risk. Practical applications of ratio spread hedging include using call ratio spreads to benefit from moderate bullish moves while limiting downside risk. Conversely, put ratio spreads can profit from bearish moves with limited upside risk. This strategy can also be employed in sideways or moderately volatile markets to take advantage of premium decay and volatility skew. In summary, implementing ratio spread hedging involves careful selection of options, strikes, and ratios, establishing a balanced position, and actively managing risk as the underlying stock price changes. This strategy allows traders to blend directional bias with risk control in options trading.